Business Finance Guide. Welcome to your complete guide to business funding in 2025. Whether you're starting up or scaling up, choosing the right funding can make or break your business success. I'm here to walk you through every option available to UK businesses today. Here's what successful businesses know. The average UK company uses 3 to 4 different funding sources, and smart entrepreneurs plan their financing strategy 6 to 12 months ahead. Let's dive into your funding options. Let's start with traditional business loans, the foundation of UK business finance. Bank loans remain the backbone of business funding, offering predictable costs while keeping you in full control of your company. Term loans give you a lump sum upfront, which you repay through monthly installments over 1 to 10 years. They're perfect for established businesses with steady cash flow and assets to secure the loan. The key benefits include fixed monthly payments for budget planning, lower rates than most alternatives, and you keep 100% ownership. Business overdrafts offer flexible cash flow support. You only pay interest on what you use, up to an agreed limit. They're perfect for managing seasonal cash flow or unexpected expenses. Think of them as your financial safety net. Commercial mortgages help you buy business premises, spreading costs over 15 to 25 years while building valuable assets. You'll need a 25 to 40% deposit upfront, but you're building equity in property that can increase in value over time. The UK government offers several schemes to help businesses access funding. Startup loans provide up to $25,000 at 6% fixed interest for businesses under 36 months old, plus free mentoring support. It's available when banks say no. The Recovery Loan Scheme supports businesses affected by COVID-19 with government guarantees that help improve your approval chances. There are no personal guarantees needed under $250,000, making it an attractive option for many businesses. Now let's explore asset-based lending, using what you already own to unlock funding. Equipment finance lets you get expensive machinery, vehicles, or technology, with manageable monthly payments instead of large cash outlays. Invoice finance speeds up your cash flow by letting you borrow against unpaid customer invoices. You can access up to 90% of invoice value within 24 hours. There are 2 types: factoring, where the finance company collects payments directly, and discounting, where you keep collections private. Asset refinancing releases cash from assets you already own. You keep using your equipment, vehicles, or property while accessing their value. It's a quick way to improve monthly cash flow without losing the use of your assets. Equity finance means selling part of your business for investment money. There are no loans to repay, but you share ownership and profits. Let's look at your options. Angel investors are wealthy individuals who invest their own money in growing businesses. They often bring valuable experience and industry connections. You get expert advice alongside patient money with a long-term view. Venture capital firms target businesses with massive growth potential. They provide large amounts of capital for rapid scaling, plus strategic guidance from experienced professionals. However, they're highly selective. Less than 1% of applications succeed. Private equity firms invest in mature businesses to improve operations and increase value. They usually take majority control and focus intensely on financial performance. Expect significant cultural and operational changes. Crowdfunding lets you raise money from many individuals through online platforms. Equity crowdfunding platforms like Crowdcube or Seedrs let you sell shares to numerous investors worldwide while building a community of brand supporters. Reward-based crowdfunding, like Kickstarter, lets you offer products or experiences instead of financial returns. You keep 100% equity and control while pre-selling products to fund production. It's also great marketing and publicity. Alternative finance offers modern solutions using technology and innovative structures. Peer-to-peer lending connects you directly with individual lenders, potentially offering lower rates than bank loans with quick decisions. Revenue-based finance provides capital in exchange for a percentage of ongoing revenues until a predetermined return is achieved. Payments are flexible and match your business performance with no equity dilution. Merchant cash advances give you upfront capital against future card sales, with repayments automatically deducted as customers pay by card. However, be warned, They have very high effective interest rates, often 40 to 80% APR equivalent. Bridging finance provides temporary funding between longer-term arrangements. It's perfect when you have a clear exit strategy within 12 months, but rates typically run 0.5 to 2% monthly plus arrangement fees. Digital Finance Revolution brings fintech solutions that use technology to streamline applications and decisions. Online lending platforms like iWalker can analyze your bank transactions automatically and provide decisions within hours rather than weeks. Open Banking Finance lets approved providers access your bank data to make funding decisions based on actual transaction history rather than just credit scores. It's revolutionary for businesses with strong performance but poor credit history. Government support includes grants and tax incentives. Research and development grants from organisations like Innovate UK provide substantial non-repayable funding for innovative activities. They're highly competitive but offer valuable validation. Regional development funds from local enterprise partnerships offer grants and loans to stimulate local economic growth. They focus on job creation and often provide additional business support alongside funding. Tax incentives like R&D tax credits, patent box, and enterprise investment scheme can significantly improve your financial position. They reduce tax liability or provide cash payments while rewarding innovation and investment. Preparing for funding success requires thorough documentation. You'll need 3+ years of financial statements, current management accounts, 6 months of bank statements, and detailed 12 to 24-month cash flow forecasts. Your business plan should include a clear business model, detailed market analysis, realistic growth strategy, and financial projections with scenario planning. Investors and lenders want to see you understand your market and have realistic plans. Legal structure matters significantly. Limited company structure facilitates equity investment, while clear articles of association define shareholder rights. Strong board composition demonstrates leadership quality. Current market conditions in 2025 show elevated interest rates compared to 2020-2022, affecting all borrowing costs. Traditional banks are more selective post-pandemic, but alternative lenders are filling gaps with higher rates but faster decisions. Emerging trends include ESG financing, where environmental, social, and governance factors offer better rates for sustainable businesses. AI-driven underwriting provides faster, more accurate credit decisions using artificial intelligence. Building your financing strategy requires a step-by-step approach. Start with assessment, analyze your current financial position, and identify specific funding needs. Then move to applications, submit to multiple sources, and negotiate terms. Long-term capital planning should include annual reviews of performance against funding covenants, future capital requirements 12 to 24 months ahead, and market conditions. Always plan refinancing 12+ months before expiry. What funders really want are consistent revenue growth, healthy profit margins, strong cash flow management, and low customer concentration risk. They also want to see relevant industry experience and a track record of delivery from your management team. Common funding mistakes include incomplete financial information, unrealistic projections, poor understanding of requirements, and single-source dependency. Avoid these by preparing thoroughly and diversifying your funding sources. Strategic success factors include anticipating funding needs 6 to 12 months ahead, building relationships with brokers and funders early, and continuously improving your financial management systems. Your funding journey should start with assessing your specific needs, then exploring options most suited to your business stage and industry. Remember, the right funding strategy can accelerate your success, while the wrong choice can limit your potential. The UK funding landscape offers unprecedented choice for businesses at every stage. With proper preparation and strategic thinking, you can secure the right funding mix to fuel sustainable growth. Take action today. Begin by assessing your funding needs, prepare your documentation, and start building relationships with potential funders. Your business growth depends on making the right funding choices now. Thank you for watching. Remember, successful funding is about more than just getting money. It's about building the right partnerships to fuel your long-term success. Start planning your funding strategy today. Visit enablefinance.com.